We're not trading the spike. Please understand, we don't do that here. We trade the aftermath. We talk fundamentals. We actually discuss what the data points that came out tell us about the economy, tell us about, you know, what the Federal Reserve may do next. Predominantly, you know, fundamental here, which I know is not the norm. I'm a little prideful about that. I like being a fundamentalist when everybody else is just technicals. It's kind of like, I don't know, it makes me feel special. But anyways, got about 15 seconds to go here. We'll go ahead and roll our breaking news. Stay tuned. All right. PC numbers coming out in just a second. Okay. PCE numbers, where you at? Alan says mixed. If anybody has the numbers, let me know. Okay, there we go. 2.6, better than expected on the core year-over-year index. 0.2%. Any revisions? No revisions. 2.6. All right. We will take 2.6. That is better than expected. For stocks, gold's going to probably like that. Dollar index, not so much. We got NASDAQ continuing higher. And you got to know also, you got to think about this. If you're saying, well, where's the reaction? Market actually moved higher into this news on both gold and NAS and S&P. 2.6% year over year. That's nice. We'll take that. Remember that the PCE number is what the Fed typically says is their preferred measure of inflation. So this is really good to see. 2.6% seems to be continuing the trend of disinflation, which is great. That gives us more confidence that the Fed is likely to begin cutting interest rates. I mean, they've said as much. They're going to cut rates. What we're more now focused on, guys, is how much are they going to cut rates in September? Are they going to cut by 25 basis points, which is 0.25%? Or are they going to cut by 0.5% or 50 basis points? And people are trying to figure that out, because if you get a 50 basis point cut, gold's going to rocket and the dollar will sell off hard. And if you get a 25 basis point cut, gold's probably not going to move too much further than where it's at. Does seem to lean more towards the 25 basis point side of things. Let's go back to our all markets view here. Take a closer look at what's happening with gold first. So gold on a 4-hour chart, still just chopping around here. Didn't seem to give us enough juice to really break the highs or anything like that. But the day is young. I mean, yesterday we started out low and then proceeded to pump right back to the highs there. So I'm watching gold. I think that it has the potential to break these highs. Could be today, maybe Monday. We'll see. But you've got this kind of interesting little formation here towards the highs where you're getting some higher lows potentially. I'd love to see this thing break and close above the highs today. If that happens, I'm going to trail my stop loss, which would be awesome just to lock something in on this trade.
Market analysis, free trading courses, edge finder data, and special offers. What do these things all have in common? They're all available for you right now inside of our free Discord. You can click the link down in the description below to join the free Discord today and get access to all of this and more. Stay up to date with all the latest trading information and A1 content. And if you want to upgrade to our Gold VIP Discord that features every single trade that Trader Nick and our other professional analysts take, you can find the links for that in the description as well. So don't wait, Go check out the free Discord today.
So again, I do like gold on the long side. I also have a nice general confirmation on gold. We're getting a +7 reading on the edge finder, which means that when looking at the economic statistics, sentiment data, technical reads, we're mostly leaning on the bullish side, which is a good thing to see if I'm long. Commitment of traders data, I went through that yesterday. Smart money, institutional money, big money, whatever you want to call them, hedge funds, banks, they have pretty large positioning on the long side according to the non-commercials COT data, showing again, big money is long gold. Seasonality still very okay for gold. It changes a little bit in September, which hurts the case study a little bit, which is, of course, today is the last trading day of August. Trend is to the upside pretty clearly. GDP stats came in pretty strong, not great for gold. Manufacturing PMI, services PMI kind of mixed. Services PMI came in strong, not great for gold. Manufacturing was weak. That is good for gold. Remember, poor economic data leans a little bit more towards bullish gold because it means the Fed may cut rates. It means that they may print a lot more dollars to sort of stimulate the economy, hence making the price of gold go up. Retail sales came in strong, not great for gold. But then labor data here, which we're going to watch next week really close. Next week you have NFP. So NFP could change these scores or keep them as is. And then you have interest rates coming down. That's very positive for gold. So overall, I really like the risk to reward for gold here. I don't like the price action right now for entries. There's nothing to do on the entry side of gold. Somebody asked me yesterday, Nick, is there any levels that you would add to up in here? And I'm like, no, the entry was here. And I know that sounds, of course it was in hindsight. I did buy this, I bought GLD, which is the ETF. And you can see my entry on this one was pretty dang rare to get it that good, but it popped right off that level. Check this out. So if you're somebody who wants to learn about how the edge finder functions, if you go to a1trading.com and then you go to edge finder features, you can read about how everything works here. So features, check this out. My team and I built this, which you can read through how everything on the edge finder functions. And I mean, the thing is with the edge finder, it's our pride and joy. I mean, this is the result of our years of trading. Frank and I and my team and I, everybody on the A1 side has worked tremendously hard just to make the tool what it is, but to create something that allows traders to better understand fundamentals. Here's the gap in the market that we see. Gap in the market that we see is that fundamentals matter, but traders don't use them. Why does everybody in the retail trading space only do technicals? I listened to a podcast last night where it was a panel of people discussing. It was a words of wisdom thing, and they were talking about how, oh, I don't mess around with fundamentals, and everybody laughed and agreed, like, oh yeah, technical only trader. And I was like, that's fine. If you are a purely technical trader and you've done your thing, then great. But for the 99% of people who are trying to use technical only trading strategies and losing money, they never even get a chance to learn fundamentals. They don't even hear, nobody talks about fundamental analysis except for, who does, and I make this point all the time, so if you've heard me say it, you know where I'm going with this. Who does talk about fundamental analysis? Hedge fund managers. Great, fantastic money managers that have billions of dollars. They're not talking about a head and shoulders pattern or a moving average cross. They may use very simple levels of technicals involved, but I've listened to a lot of them. I listen to them all the time on, you can listen to CNBC and listen to people who manage a lot of money on there. And are they talking about technical analysis? Nope. Maybe a little bit, but they're not using technicals. They're using fundamentals. And so I want to just say that if retail is all using technicals, but then professional money managers are focusing heavily on the fundamentals, there's got to be something. There's got to be a reason they're putting themselves through the agony of learning fundamental analysis, right? Because fundamentals are not easy to learn. But why does retail only focus on technicals and these money managers are all about the economy, the Federal Reserve? Why are they all focused on that? Just got to ask some questions, right? We just got to think here for a second. It's almost like, if you want to get conspiracy for a moment, it's almost like they want you to just stare endlessly at charts. Don't look at this stuff. Don't look at that stuff. That's for people wearing suits and making billions of dollars.
Nasdaq, USDT, and also gold. Sorry, and also US oil, because it was moving very nice. So yeah, but mostly I can say Nasdaq and actually US as a whole, because they have a direct impact to each other.
Sure. So you've got the dollar index pulled up here. A little bit of a pop in the dollar this morning. Are you thinking that the dollar continues lower? I'm kind of in that camp personally, but what are your thoughts on the dollar index?
Yeah, I believe we're still gonna see a very nice move to the lower side, because PCE, it was like very cool. So it's not really bad thing, or maybe a good thing. We can say it's neutral. So I think we can still see a continuation of that sell, because at the moment this sell it's because we now expect, or we are very closer to the rate cuts. I think this is the few days until we reach September. So which means from there we will be just talking about rate cuts, and this is the first pair to be impacted by that. And almost every economic news that we got, they all actually very, very, very cool, or we can say they did not really actually go aggressive.
Sure.
And that is actually what we want. I think I'm expecting it to go lower. If it doesn't really go aggressive, I'm just expecting it maybe to consolidate slower, but not really going up that much.
Yeah, and when it comes to the dollar index, when you have these pullbacks, as you mentioned, the inverse relationship to gold, so you have gold sort of moving down here today. It's not a perfect correlation. Gold and the dollar can technically move in the same direction, but today seems to be, weighing a little bit on the gold price action. I was curious your thoughts on this one, because if we do see, a little bit more selling on gold, that would put it at 1, 2, 3, 4, the fifth time here on the 4-hour chart that we get a rejection from this level. Do you think that's telling us that gold is topping out in this area? Or do you think we're just consolidating before potentially breaking through that high and continuing past that all-time high around 25.30, let's call it 25? Yeah, about 25.30.
Yeah, I think we have a very nice structure. What's really happening there, I think it's a very clear resistant structure. I feel like we have like 1, 2, 3, 4, 5 touches. One way or another, I think the market will be trying to break out of that structure. We can see that even though the market is trying to go a little bit lower, but it's not really that enough. Bullish momentum is quite aggressive. And I thought maybe PCE was going to change that, but a bit disappointing. So now I can say, yeah, there is enough room for gold to even go higher, because at the moment we're no longer going to worry much about PCE. It's just going to be, okay, now what's next? It's just about rate cuts, or maybe few economic news that we're gonna have the coming weeks. But at the moment, I think it's about, we're just waiting for gold to break. I don't think we have any barriers that can stop us from buying at the moment, because I think it's like clear that the rates, they will be cutting the rates, whether it's 25 basis points or 50. But I think that it's still very good for something like gold.
Yeah, I agree. And I think that the concept of knowing that, interest rate cuts are coming has definitely played a role in keeping gold where it's at. I also wanted to discuss something on gold with you for a moment. When we saw gold make this kind of move at the beginning of the year, where you had this kind of really violent upward trend, as opposed to what we've sort of progressed into in recent times, which I would say is more of a kind of slow chugging uptrend. If you take a look at the trajectory of this uptrend versus this uptrend, very clearly, it is two different types of uptrends. Yes, they're both trending up, but one is gradual and one is very rapid. And the reason that I can attest that to is that we started out here, with a little bit of fear, right? Because you had conflicts arising all over the world. You had, sure, the Fed was expected to eventually cut rates at that time, but it was a lot of fear. Whereas now there's just more emphasis, it seems like, on, easing. So the two different uptrends, I'm curious to get your thoughts on this if you agree with this, but I think that the reason the trend is still up but gradual is because the Fed cutting rates into a soft landing is good for gold, but not phenomenal for gold. I think that if you had cuts plus fear, like rate cuts plus like fear in the economy, you would get this sort of move again. And some traders might think that, hey, we might go into that fear of again, and that may cause a melt up on gold if you get, rate cuts for, trying to save the economy and things are crashing. That would be possibly a very bullish kind of couple of years for gold. Whereas it seems right now we're more in this camp of we're easing gradually from the Federal Reserve. Doesn't seem like a crisis, and that still favors gold for rate cuts, but not nearly as urgent to buy gold as it is in a fear environment. Does that make sense to you?
Yes, you're right. Remember, that's the reason why we say gold is actually a safe haven, which means a safe haven, it means things will be going crazy around those times. If you want to buy gold, it means things are not going very well. Maybe there is geopolitics and stuff. But when we cut the rates, like now, we can say by cutting the rates, that is going to be good for consumers in the US and stuff. So that is actually a good thing. It doesn't really create any panic, you see. So actually, gold, we can say, I like to say this, it's like gold and VIX to me, I think they were supposed to be the same because mostly they measure fear. If maybe you see gold flying, most likely there is something very bad happening around that time. But if things are cooling off, most likely we'll see it performing not really that good. So I think rate cuts are good for gold, but it's not really everything. It's not gonna fuel gold to go crazy, you see.
Yeah, no, that makes sense. There's got to be that for gold to go up in that trajectory, there's got to be like urgency and fear to buy gold rapidly. Whereas now there's just like a steady demand for gold alongside, other things that might do well in a rate cut environment. We talked gold for a moment there. I want to also hear your thoughts on the NASDAQ, Kenzo. So NASDAQ's been bouncing back here. Is the uptrend back? Are we still, do you think we'll see perhaps a hit of the all-time high again before the end of the year, or do you think we may go sideways? What are your thoughts on the NASDAQ?
Yeah, on the NASDAQ, I think I'm expecting to see a continuation of a bullish move. Yes, we're coming from this aggressive down or aggressive sell. At the moment, I'm expecting actually a reversal, even though it might not really happen very quick, the same way as the previous sell-off. But with the way we see things now, we just received some earnings from NVDA, which shows that, yeah, we still have that AI continuing. The demand is still there. And mostly, I think maybe sometimes we focus too much on NVIDIA, but we don't really focus on Microsoft, Amazon, or other companies that are buying those GPUs from NVIDIA. So if you check how they're talking now, beside NVIDIA, you can see that they are still going to buy more. So which means NVIDIA alone, yes, maybe people they might sell now, but actually we can still see enough. Even to next year, I think we can still see a nice push to the upside. Along the way, people they will take profits, or investors they will try to cut their profit. They will try to rebalance their their portfolios, and that it comes with a cost. Once they cut that, obviously the market will perform very bad, but after that the market will recover, because what we see now is not really like bad performance from those companies. It's just that people, they're just cutting their profit. I think this last month we saw Warren Buffett, he took his profits, actually, or let's say he sold his shares from Apple. So obviously once we see something like that, we're gonna see a major sell, but it doesn't really mean the company is performing very bad. So I think that it's also what we see on Nasdaq. When the market is higher, obviously people, they will take profits. Once it's lower, I think it's gonna be a very good time for us to look for a continuation of a buy. Plus we have rates cuts coming, so that is also another plus. And we saw the results. They did beat the estimation, but unfortunately most of the time it happens like this. Every time they, let's say mostly these bigger companies, when they release their earnings, the market tends to sell. I don't know if maybe people are just cutting out their profits before, because the market mostly it will be on the highest level.
Yeah, NVIDIA was an interesting one, Kenzo, because NVIDIA, it did beat its earnings, but it didn't beat them by the same percentage, didn't beat them quite nearly as much as it's beat them in the past. So, here was a 20% or 19% beat on earnings, 12% beat on earnings, 9% beat on earnings, and then the latest one was just a 5% beat on earnings. So it's like, but that just goes to show, to your point, they beat earnings, market still sells off because the expectations for this company are so high. That being said, though, the way I take this is this is still very positive. They beat their earnings. It is still a growing company, and the revenue growing like that may not be, absolutely dazzling to some of Wall Street, but it's still very good growth. It's still showing demand for semiconductors. And in terms of the rest of the tech trade, I think it still is still intact. Not to mention, as you just discussed, if we have the Fed cutting interest rates and the economy holding up, the demand for chips is probably not going anywhere for a while. And so, if we continue to see the economy, see evidence that it's holding up in the meantime, it could be just fine. And some economic data points just to reference is, we've still got PMIs here at 51.4 compared to, previously we were at 48.8. So services is still growing. Manufacturing is not growing, but it's not, falling apart. This has been kind of a consistent theme for a while. So manufacturing is, slowing very gradually. And then look at GDP growth. If we take a look at GDP growth, yesterday we had remarkable GDP numbers. And this is just continuing to show that, for people who are very fearful of a recession, it's possible that we do go into a recession at some point. But remember, a recession is 2 consecutive quarters of down GDP, negative GDP. And we're still putting up some pretty strong growth in the US. So the point is, if there's good GDP numbers, this is also very generally good for semiconductors, very good for, company earnings in general, because you want to see the economy's growing, the hiring stay strong. If we can get some bounce back in labor data, that will be very convincing that we could potentially see this soft landing play out, where the Fed actually does end up seeing inflation come down, cutting interest rates, and that spurs and keeps going with the growth from here. So it is possible that we kind of see that dynamic play out, and could be very interesting. But again, economic data overall looks decently strong enough, especially with rate cuts on the horizon. And I do think that path of least resistance for indices is higher until proven otherwise. I think with the indices, Kenzo, we've kind of got to think of them as innocent until proven guilty, right? They've been doing remarkable. They've been putting up great numbers. Let's see if they can. They're innocent until proven otherwise, right?
Exactly. Yeah. Plus, on the indices already, we did have a proper sell-off, I think, a few weeks ago. So I think that it was enough, because it happened very quick. So for now, for the market to recover, I like the fact that it's not really recovering very aggressively, because if it was aggressive, maybe it was supposed to reach this level. So at the moment, we're still at the middle, which means it's good. If maybe the market start to go higher, it's fine, because that maybe might be throughout September until they cut the rate. So to me, I think it's fine. But if maybe the market was just jumping straight up, that was going to be a problem. Maybe we're going to have another sell-off again. But this sell-off that we had last week, I think it was enough. Maybe the market might not really give us those bigger moves, but it's better if it keeps going up slowly. I think the economy, obviously, one way or another, as you said, GDP is performing very well. Two in a row means we're not actually expecting any recession anytime soon. And that obviously it has to reflect on our indices, but I think it will be quite slower. But the rate cuts, we'll just have to wait for them, whether they cut with 50 or 25. I think that will still be good. Unfortunately, just because we're talking about it that much, once they cut with 25 basis points, that won't be any surprise, or it won't entertain investors, and the market might not really move that much, unfortunately.
Mm-hmm. Yeah, and I think that even if if it doesn't move that much, it would be just fine, because we've had a nice bounce back. We've had, some nice gains in the S&P, and the actual announcement of rate cuts are unlikely to be a very big market mover. Like the actual day, usually the market already knows with pretty good precision what they're going to do. It's more about the rumor for the future ones, right? So as we get closer to September, the market will get a pretty good idea. It seems right now like 25 basis points is appropriate, not 50. And if that happens, then the market, I would actually say that's a really good sign. If you get 25 basis points instead of 50, that would tell me, okay, we're seeing, the Fed ready to cut rates, which is great, but we're not in a rush to do so, which is also great. Shows that they think the economy is in a good enough place. If you get 50, it's a little up in the air. If they say 50 basis points instead of 25, if that were to happen, it would depend how they deliver it. Because in some ways you could say, they may have missed the starting point. They might have gotten it wrong. That might concern investors. But if they deliver it in a way where they're like, we feel we're sufficiently restrictive and we feel like we can start a little heavier on the front side and then proceed with like 25 basis points from there, I think the market wouldn't hate that. They'd actually probably celebrate it and be like, okay, yeah, rate cuts, that'll do something, and then go from there. But really, I've made this point many times, Kenzo, and I'm sure that you have as well. It's not about the rate cuts themselves. It's about where the economy is when they're doing the rate cutting and how fast they're doing it, right? So people are, constantly wondering, when they cut rates, is that going to make the market crash? But the full answer is, well, it depends on the state of the economy as they're cutting rates.
Did you know we do a live trading show Monday through Friday with guests from all over the world? To get notified when we go live, click the bell button next to the subscribe button, or check in at 9:30 a.m. Eastern Time. We have helpful, free content in the description below and on our website, a1trading.com. Thanks for watching today's video, and we'll see you tomorrow.